Welcome to Coffee Chats with Klaas. Hi, I'm CJ Klaas with Klaas Financial, and today I'm here with Eric Schwartz, Certified Financial Planner, to discuss an advanced planning topic related to employer-sponsored retirement plans called Net Unrealized Appreciation, or NUA for short. Eric, can we start with an overview of what Net Unrealized Appreciation actually is?
Sure. Net unrealized appreciation may apply to individuals with a 401k plan that holds shares of stock in their employer. If certain criteria are met, the IRS provides favorable tax treatment for the gains on employer stock when it is sold. Net unrealized appreciation is the difference between the price paid to purchase the stock, also called the cost basis, and the price of the stock when it is sold.
Why does the IRS provide favorable tax treatment in this particular case?
The IRS provides this benefit specifically for shares of employer stock in an employer plan. The idea is that they're creating an ownership mentality among employees, which hopefully leads to more productivity.
Tell us a bit more about how NUA provides favorable tax treatment.
Generally, any distribution from a tax-deferred retirement plan are taxed as ordinary income. However, through NUA, the gains on employer stock owned in a 401k are taxed at long-term capital gains rates instead. Long-term capital gains rates, which are 0%, 15%, or 20% depending upon your income level, are lower than the corresponding ordinary income tax rate. It's important to keep in mind that the cost basis is still taxed as ordinary income.
You mentioned earlier that there are certain criteria that must be met to receive the special tax treatment. Can you tell us more about that?
Yes, this is where things start to get a little complicated. First of all, let's talk about the method and timing of the sale of the stock in order to qualify for NUA. The shares of employer stock must be distributed from the 401k to an after-tax brokerage account before being sold. That's very important. The sale must occur after distribution from the 401k. So the shares of company stock must be moved in kind, or without being sold, from the 401k to the after-tax account. At the same time, any remaining assets in the 401k must be distributed, either as a distribution to the owner or as a rollover to another retirement plan. Finally, in order to qualify for NUA, distributions must come after a triggering event, which could be termination of employment, death, disability, or turning 59 and a half. It's also important to note that distributions before 59 and a half could still be subject to the 10% early withdrawal penalty.
When are shares taxed under NUA?
So the cost basis of the shares is taxable as ordinary income during the year of the distribution. However, the gains are not subject to capital gains tax until the shares are actually sold in the brokerage account. Interestingly, all of the shares are eligible for long-term capital gains treatment, even if they have not been held for at least a year.
Who would be a good candidate for an NUA strategy?
An individual with company stock in a 401k that has grown in value significantly would be a good candidate to consider a net unrealized appreciation strategy. The larger the growth on the company stock, the more beneficial the special tax treatment becomes. Without significant growth in the stocks, the tax benefit of NUA is limited and can even be detrimental. Net unrealized appreciation is an especially complex planning technique. Please be sure to work with your financial advisor and your accountant to determine if it is a good strategy for you.
Thank you for your thoughts on this complex topic today.
My pleasure.
And thank you for tuning in to Coffee Chats with Klaas.